this module, we are going to be covering the topic of treasury stock. This is when a company repurchases stock from the open market, so they're repurchasing the equity and holding it temporarily. So, as I mentioned, in some cases, a company may decide they want to buy back some of that stock that they've issued. You'll often hear this referred to as a stock buyback. And there are a variety of reasons they may want to do this, and a variety of things they could do with it. The first one, which is really the main topic of this course, they could hold those shares temporarily as treasury stock. They could also decide to retire them or deissue the stock. It's up to them. Do they have a plan to do something with these shares in the near future, or do they want to just permanently deissue them? Now, treasury stock, what could they do with this? Why may they want to hold this as treasury stock? In some cases, they need these shares because they plan to reissue shares to employees or managers as compensation. So they also may have stock dividends they want to pay out instead of cash dividends. To do that, to issue new shares as stock dividends, you need to have a sufficient number of shares. You may be exercising stock options, and you may be preparing for it. And again, in order to sell these shares of stock to the employees or managers at that stock option price, they have to have the number of shares available, either now or they'd have to buy them from the open market at that time. But some other reasons, these bottom two reasons, are really the kind of the core reasons for treasury stock. The company may feel that the price on the open market is less than expected. So they may feel that it's undervalued. If you go to supply and demand for anything, it applies similarly to shares of stock. If the supply of the shares is high and not as many people want them, then the price may fall. So if the company just feels that that's less, it really undervalues the company, they may be willing to sacrifice their own cash to buy back some shares of stock. And then the goal, they hope that the price increases over time, so they would resell it at that point. One thing I want to point out here is that when you sell your shares of treasury stock, you cannot reflect a gain or a loss. Now, keep in mind, the company is the one doing these transactions. They obviously have all the insider information that anybody would have. So they have to be careful of certain insider trading rules, and they can't make trades on non-public data. They can't buy shares back at a low price, knowing full well that the next day they're planning on issuing some information that's going to increase the price of the shares. They can't do that. Now, it also reestablishes confidence in the company. If management is willing to sacrifice their cash to buy these shares back, then that may send a signal to the market that, hey, maybe this is going to be more successful down the road. Otherwise, why would management sacrifice that cash? Now, as we get into this topic, there's a very important thing I need to point out here. When we see treasury stock on the balance sheet, it is in the equity section. It is not an asset. If you buy shares of some other company's stock, that would be treated as an investment or as an asset. But if you buy back shares of your own stock, it's not an asset. It's not an investment. Instead, it's a contra equity account. It offsets owner's equity. So you'll see common stock, additional paid-in capital, and then less treasury stock. Keep in mind, when we first issued the common stock, that increased the common stock account. So if we hadn't issued that at all, that would have reduced equity, or equity would be at a lower rate. Treasury stock is the same basic thing, except we are holding it in this separate account, so we have to reduce it in that separate account. And then we have retained earnings, whatever the amount is for that. That gives us total equity. So the biggest thing to remember is treasury stock is not an asset. It's a contra equity account. That contra means that it offsets equity, but it also tells us it has the opposite normal balance of equity. Equity, or the capital accounts, they have a credit balance. Treasury stock has a normal debit balance. So while it may look like an asset because it has a normal debit balance, it's not an asset. It goes in the equity section. So let's take a look at some purchase journal entries. Again, Treasury stock has a normal debit balance, so we increase it with a debit. If we're buying back 30,000 shares of Treasury stock at $10 each, we would debit Treasury stock for 300,000, credit cash for 300,000, and we show that we've paid for this in cash, and we now have a debit balance in Treasury stock, which reduces overall owner's equity. Now, perhaps even more important is how to handle the resale of Treasury stock. There are two methods that could be used, the cost method and the par value method. The cost method, if you're taking a basic accounting course, this is what you're going to be dealing with. The par value method will deal with more in the advanced modules for intermediate accounting. But for right now, the cost method is what we're going to focus in on. I'll give you a brief overview of par value. But with the cost method, what we do is we keep track of the cost that each and every share was repurchased at. So how much did we have to pay to buy it back? Now, if we sell it again at a higher or lower price than the cost, that's not going to be a gain or a loss, but we use an additional paid-in capital Treasury stock account to record those increases or decreases. So we have to set that account up. Now, the par value method, it doesn't track the cost of the stock that we paid back. It tracks the par value instead. So your entries get a little bit more complicated there. We're going to have any additional amount, just like with regular stock. If you buy and sell regular stock above or below par, you have that additional paid-in capital account. So it's the very same thing. We're treating this almost as a reversal of the original entry. So again, I'm not going to get too far into depth with this topic, this method, but it will be discussed in more advanced lectures. So we're going to take a look at a few examples here to really flesh this out. The resale of stock journal entries above cost. So if we sold Treasury stock back above what we originally paid for it, keep in mind it is not a gain. If you did that same thing with some other stock that you owned of other companies, it would be a gain on sale of investment. It's not the same for Treasury stock, though. So we have to credit the Treasury stock at the actual cost. That reduces the equity reduction. Keep in mind, Treasury stock itself is a reduction. So if you reduce that reduction, I know it seems a little duplicative, but if you reduce the reduction, it's a double negative, you have an increase. So by crediting Treasury stock, reducing Treasury stock, you're increasing the equity. So again, that's at the cost itself. Those shares, if you recall, they cost us $10 earlier. Now we're reselling 10,000 of those 30,000. So that's $100,000. We're debiting cash for the actual amount paid, or received, I'm sorry. 10,000 shares at $15 a piece gives us $150,000 cash received. The other $50,000 on the credit side, again, it's not a gain, but that item that looks like a gain is going to be considered additional paid-in capital, Treasury stock. So the reason for that additional paid-in capital Treasury stock is really to help offset future situations where we sell below cost. So let's say now we're selling some shares below cost, 10,000 shares. So remember, we had 30,000 total. We already sold 10,000. We're selling another 10,000 now at $8 each. $8 is below the $10 cost. So we have to debit cash for $8 times 10,000 shares, or $80,000. Now the Treasury stock has to be credited at cost. 10,000 shares times $10 is $100,000 cost. On the debit side, we're going to have an additional paid-in capital for $20,000. We're reducing that fund that we set up a bit ago. That additional paid-in capital, now we're using some of it up. Before we go to our last entry, let's take a look at where are we sitting currently. We still have 10,000 of the 30,000 shares left that were issued at $10 per share. They were bought back at $10 per share. We have a credit balance of $30,000 in additional paid-in capital. Now, if we go back here, that was the $50,000 that we set up initially minus the $20,000 we've already used. So we have $30,000 left. So now we're going to take a look at our final 10,000 shares. We're going to sell them at $5 each, which is below cost. So keep in mind, we have that additional paid-in capital that we set up with a credit balance. We've already debited it once, but we cannot push it to an overall debit balance. That creates a negative capital account. We cannot do that. So we're going to have to see in this situation, how do we handle it if we sell additional shares below cost. If we do not have sufficient additional paid-in capital treasury stock to debit, in other words, we ran out of that fund, we have to debit retained earnings directly. That would be reducing retained earnings. It would be the same treatment as if we called this a loss on sale of investment. Again, it's not really a loss, but it would have the same overall impact. So let's take a look at the various pieces of this journal entry. We know we have to pay, or we are receiving $50,000 in cash. 10,000 shares at $5 each, $50,000 of cash. So that one we know right away. Let's jump down to the treasury stock. We know it's going to be 10,000 shares multiplied by the $10 original cost, so we know that's going to be $100,000. We are now off by $50,000 on the debit side. We only have $30,000 left in our additional paid-in capital account to debit, so that's all we can do. We debit that for $30,000. The additional $20,000 has to come from retained earnings. It has to reduce retained earnings. So it's a debit. Again, in the end, our debits and credits have to balance out. We know the cash. We know the treasury stock. We know that we only have $30,000 left in additional paid-in capital, so the excess amount has to come out of retained earnings.